So we've figured out 4 different price targets using 4 different valuation methods. We've got the free cash flow DCF, we have the price to sales valuation, the EV to EBITDA valuation, and the dividend discount model valuation. So what is the target price for this stock given all of these different valuation methods we've used? Watch the video to find out. What's up everyone, my name's Robbie, this is Robbie Manila, and today we're doing a stock analysis on Verizon. So we're going to change up a little bit of the order of these videos. I want to make it a little bit more easy to understand, faster. So I'm going to start leading off with this video with the dividend discount model valuation. A lot of people like Verizon because it pays a good dividend. So the first thing we're going to do is find a target price for Verizon using the dividend discount model. The next thing we're going to do is we're going to use a price to sales model to find the price target for Verizon using that methodology. Then we're going to use a EV to EBITDA valuation methodology to find a price target that way. Then we're going to go through my proprietary system, the CAT 5 score. We're going to see how it scores using those different things that I care about. And then we're going to go through a discounted cash flow to figure out what the target price should be using that methodology. We got a lot to go over in this video. Let's go ahead and let's get this thing started. Okay, so for all you dividend investors out there, the first thing we're leading off with today, of course, is the dividend metrics of Verizon. Very important for a lot of you investors. So what I have here is the first thing is the dividend increase history of Verizon is 18 years. Not quite a dividend aristocrat, but you know, it's getting there, so it's on its way. The dividend yield is 4.73%, which is a great yield for any stock. And then the question is that going to be justified, or is this yield too high for the company? Is there any problems? We're going to go over all these different things. The dividend growth is 1.71%. So decent dividend growth, not great, not amazing, but it's nothing that is to be concerned about. It should be completely fine for this company to grow its dividend at that amount each year. The free cash flow payout ratio, we're not going to go by this yet because there are some things that we need to adjust here. So don't worry about this yet. So what we do is we take the capital asset pricing model, which is CAPM. What we do is we take the 10-year treasury, which is a 1.91%, the beta of Verizon, which just remember that this is a very low beta stock. This does not trade like in crazy volatility. So for this stock to move like high to the upside, it's gonna take a while because it's Verizon and it doesn't have a high beta. It doesn't move in large price increments very fast. Just something to be mindful of. So the expected return I'm using for myself is 9%. And then what we get is we get CAPM, which is the capital asset pricing model, 4.68%. We run that through the dividend discount model. We then use this through the dividend discount model, and it gives us a fair value for the stock. This gives us a fair value of 85.30 for Verizon. This is the current price is 54.12, and this gives us 57.61% that Verizon is undervalued. Now, the discount model is a little sensitive, and actually I think it probably is a little higher than it should be in terms of the other valuation methodologies that we're going to use. But remember, we're going to just use an average of all these different valuation methodologies at the end of this. So this is going to be a part of that. Okay, so now we're moving on to the price to sales valuation. So here's what I got here. So first off, are the shares of Verizon increasing or decreasing? So what's happening is the median and averages are a little bit different. So the median increase for Verizon was 0.25% over the past 10, 5, 3, 1 years. This is like the median of these, or the average of these is actually 1.10. So essentially we can kind of decide what we want to use here. 3.74% is going back 10 years, but more recently 0.34% is the share dilution. So 0.31%. So what I'm doing is I'm going with 0.25%. I'm just going with the median here. I don't think they're going to dilute us too much going forward. So this might be a little bit aggressive, you might think, but that's what I think. So I'm not diluting the shares that much. So once I get the shares, then I have sales growth. So this is step 2. We need to do the sales growth forecast. So we're taking the different sales growth here. Over the past 9 years, 1.60% has been sales growth or revenue growth. But over the past 5 years, only 1.18%. So I'm using a 1.50% revenue growth or sales growth number going forward. I'm forecasting this from $135 billion, which was the revenue, my forecasted revenue for 2021, going up into 2026, being $143 billion. So this is the forecast of revenue going forward. Step 3, we need to figure out the multiple, the sales multiple. So what we do here is we say, okay, 2017 through 2021, these were the averages for the multiples, the price to sales multiples. The median of these was 1.78. The average was 1.78, so we're very close, median and average, that's good. What do we want to use as our price to sales multiple? Because we need to base that on something, because that's going to help us determine what we think the price of this stock is going to be in the future. And so here's our price to sales multiple options. And so this is a pivot table. And you can see, for example, how we read this is in 2022, if there's a price to sales multiple of 1.5, it was never 1.5 going back in this historic price to sales ratio, so that's very conservative. But so if it is 1.5, it's 48.90 at the end of this year. That's the price target of the stock. But if it is instead 2, which it also never got to 2, so that's also very aggressive, then the stock is worth 65.19. So this is what we're doing here. We're projecting this to 2026. So these are the potentials that it would be in 2026, 2025. So these are the projected prices of the stock based on the multiple of revenue. These are the different rates of return if you achieve this. So what I'm doing is I'm saying, let's go with 1.78. I'm going with the median of these different price to sales multiples. So 1.78, this is what I'm saying the price target would be. $58 by the end of this year, 60.97 by 2026. Down here, we can see the rates of return if this happens. So 7.21% by 2022, by the end of this year, would be your growth rate. Not great, but you are getting a good dividend as well. And this is not a stock to probably own for giant growth, but we're gonna see at the end of this the actual price target that we have. This is what I'm going with for the price to sales based multiple valuation methodology. Let's go to the EBITDA methodology. So okay, share increase, decrease, we have the same information here. I'm diluting us at 0.25% per year. We have EBITDA growth here. So EBITDA growth, over 1 year, it was 6.79. Over 9 years, it was 5.75. That was the growth, the annual growth rate in EBITDA. So we have a median, we have an average. What are we gonna do here? I'm gonna go more conservative. I'm gonna do a 3.21%, that's the 3-year average, and I'm actually going to have this decline going forward because there are some things with this company I don't necessarily think growth is gonna be great. We're gonna show that when I go over the CAT 5 score, but 3%, 3%, 2.5%, 2.5%, down to 2% by 2026. EBITDA growth. This is the forecasted per share EBITDA. So here on step 3, we have the EV to EBITDA multiple. And so what we're going to do is we're going to figure out what to use for EV to EBITDA multiple. So the historic EV to EBITDA is 2017, 7.86, up to 2021, 8.03. These are the different ranges we've had. So basically the average of these, 8.23, median 8.22. So I'm going with a more conservative one on this. I'm using 8 for this. So that would be 2022 target price, 61.65. By 2026, it's 67.37. Basically, this equates a 13.9% rate of return by the end of this year, going down to only 4.48% by 2026. So holding this stock till then probably wouldn't be a great rate of return, but if you sold it at the end of this year, it would be. Next up, we have the selected price target that I'm going to use for my weighted average will be 61.65. Let's go to the CAT 5 score. So CAT 5 consists of 5 different categories, hence the name CAT 5. And so what I do here is I first go over what I call the Rolex score. So the first thing I do is I look at the F score of the company, the Piotroski F score. So I want a 7 or more to get 5 points in my score. A 5 or 6 is going to get 2 points. And if Piotroski F score is a 0 to 4, it gets 0 points. So where did we get points with Piotroski? Where did we not? So basically, if you look over here, the areas that we did not get points for Piotroski F score was lower leverage year over year. So there was higher leverage year over year, which is not good. Higher current ratio year over year. There was not less shares outstanding. There's a higher gross there was not a higher gross margin year over year, and there was not higher asset turnover year over year. These are things that you want to see with Piotroski F score, and Verizon did not accomplish those things. So the F score for this company is a 4. It gets 0 points because we want 7 or more to be the best. So we're going to now move on to shares outstanding. What I'm going to say is it's increasing, and we don't want shares to be increasing because that dilutes us. So I'm actually giving them a 0 on that one as well. Next up, industry-based valuation. What I do here is I say, what is the PE ratio compared to the industry? And I use a decile system to figure this out. I'll show you what I mean. So for example, I have 19 companies in this industry that Verizon operates under. What I do is I take all the different PE ratios and the whole entire industry, so all those 19 PE ratios, all the ones that are positive, I rank them into deciles. So if you have a 1.35 to a 4.11, you're in the first decile of PE ratio. Basically, the PE ratio for Verizon is 10.18, so that means that it falls into the 5th decile of PE ratios. Now I want it to be a higher decile because it means it's a cheaper company. It's a lower PE basically. So that's how we do this. So we rank them into deciles so that we can pick a good decile to be in, and it gets points if it's in a good decile. So 5th decile, 10.18. Of course, it's not a high PE ratio, but again, it's compared to the industry. So, okay, we got a 2 here, a 2 out of a potential 5. So it got some points, but not the best. We wanted it to be in the 4th decile or better. Next, we have for the forward PE ratio, it's in the 3rd decile. That's good. So 9.62. So that gets a 5. So that's good. So that got a full score. Then we look at the price to sales ratio, 1.65. So it doesn't get full points, but it still gets 2 points. Next, we have price to free cash flow, 25.06. I might actually think to myself, oh, that's kind of high. Well, compared to the industry, it's not too bad. It's in the 6th decile, so it still gets 2 points. So it gets 20 points, and 55% is the peer valuation score. Here we have industry-based profitability. So what are we looking at here? 5th decile, 57.90 is the gross margin. The net margin is actually in the 1st decile, so it has a very good net margin. So I really like that. 22.80, that gives us a 5, a full score. So this actually gets a 70% for industry-based profitability. So actually, profitability-wise, this company is doing okay compared to the industry that it operates in. Next thing we want to talk about is the industry-based growth of this company. So it's in the 9th decile for revenue growth, not very good. So not liking that at all. 1.20% revenue growth over the past 5 years. That's not so great. That gets a 0. Earnings per share growth, however, is okay with a 2nd decile. So that actually is 10.62%. So earnings are actually growing a pretty decent clip. That gives us a 5 out of 5. Nice. The free cash flow, I like this to be higher than 10%. This is not quite there. I'm going to go through free cash flow in a second because we need to make some adjustments to figure out the discounted cash flow. So we get a 2 on this one. 15 points, 47% for the industry-based growth. Not a great growth story. Of course, Verizon's probably not going to be a growth company. It's a value play. Last thing we have for CAT 5 is the liquidity score. I like to see a debt-to-equity ratio of no more than 2.5. This is 2.18. So it's not the best. This company does have debt for sure. I would love for it to have less debt. Don't love debt. I know the company, the industry that operates, there's a lot of capital expenditures and things like that. So, or it gets a 2. So it gets total possible is a 5. So this only gets 40% liquidity score. To recap real quick, the Rolex score was a 0. Pure valuation was a 55%. Pure profitability was 70%. Pure growth 47%. Liquidity 40%. Only gets good. Only gets a full score. That's something that I think is a passing rating for the profitability. Interestingly enough, I didn't think that was going to happen with this company, but it did. And we have a 27 out of a total possible of 60, which is a 45%. I like to see this at 70 or higher personally. Let's go finally to the discounted cash flow. So I've alluded to this throughout this video about cash flow, how we're going to have to make some adjustments on this one. So let's go back. 2018, 16.2 billion in free cash flow, growing in 2020 to 21.450 billion. But then we had the negative 28.3 billion in 2021, and you might be thinking to yourself, that's awful. Let's define what that is so we can make an adjustment for this. So this is the 10K of Verizon, and what I'm looking at right now is the statement of cash flows. And so what I'm looking here is I want to show you this little line item here. We're in cash flows from investing activities. And so this is a giant sum of money that was paid by Verizon. Verizon paid $47 billion to bid to get licensing to 5G networks. So a giant amount of money that it had to pay, which is just inherent of this company. There's lots of capital expenditures for Verizon to create these networks and things like that. So we have to adjust that. We can't keep that on like the cash flows when we're like kind of figuring out the free cash flow based DCF, right? So what do we do here? Well, I guess what we could do is we could say, well, what if we just subtract 47 billion, because we know they're not going to spend 47 billion every year, but maybe, this the licenses that they got are going to now increase capital expenditures going forward. So they build out this 5G network. So there's that part. So what do we do? Let's go with, let's say 45 billion is going to come off of the free cash flow for this year to adjust it. So what that's actually going to do is going to look like this. So instead of free cash flow being negative 28 billion, we're going to make it positive 16 billion 600 million. And so there you go. Now we have more of an adjusted free cash flow. I'm being conservative here, but what I'm actually going to do is I'm going to use 3.95 as the base for the free cash flow per share. If you do look here, the free cash flow from 2018 to 2020 grew at 14.8%. I don't think that's going to happen long term going forward. Maybe we'll say 8% or so, but we're going to use 3.95, $3.95 free cash flow per share. Let's grow it at 8%. I'm in Guru Focus's discounted cash flow calculator, 3.95 here. I'm going to use a discount rate of 9%. I'm going to do a growth rate of 8%. And now we're looking at a price target of 65.64 for free cash flow, based discounted cash flow. That's the answer to that one. So margin of safety, 17.55%. Like to see this around 25%, but let's take a look at the weighted average. So all right, this is what we got. This is our weighted average target price for Verizon. So first we have the free cash flow based discounted cash flow, 25% weighting towards that. Gives us that was our target price of around $66 per share. Then we had the price to sales valuation method that we used, $58 per share. EV to EBITDA valuation, 62. Dividend discount valuation, which was a lot higher, with an $85 per share, gives us an weighted average target price of $68 per share. I'm on the high end of analysts. I think the median analyst rating is around 58 or so. The highest was around 72. So this is on the high end. I thought I was being pretty conservative. Let me know what you think in the comments below. But this is what I got. Decent dividend paying stock. Actually, apparently, according to this, it has some upside potential as well. So now let's go ahead and take a look at some of the technical analysis for the chart real quick. All right, so zooming out, getting a nice big picture of what's been going on with Verizon. This chart goes back until August of 2015, around that time period. And we can see that it's really traded within a range here of about $49 up to $61 per share. Remember, this is a low beta stock. It's not very volatile. So it's currently right now in a downtrend channel. Now let's zoom in here and look a little closer, see what's going on. So as you can see, Verizon, double top, 1, maybe even triple, 2, 3, rejected. Downtrend, 53.89, made its way up, and then it's been in a downtrend channel. This is the support level at 49.85, and what I see here is an ascending triangle, which is a bullish pattern. If this thing bounces down, up, breaks through this resistance area, could have a decent upside here. I'd watch this to see if that happened. If you care about timing and entry point, if you don't, just want to dollar cost average this, totally great. If you like to time entries, fine, do this. If you don't, ignore all of this. Buy the stock if you think the stock is a good buy. Upside getting up to 61 here is 13%. So if this thing could get up to this resistance area where it hit this triple top, that's where that is. Now, if it goes down, if it breaks down through this support, which is 49, how far down could this thing go? Well, now we're looking down here at 46. That's 13% downside. So whatever happens, I do think this is a bullish pattern. So I think that it's got that going for it. Otherwise, RSI on the way up, but still in the neutral area, and MACD is looking like I'm not seeing anything going on there. So that's it. That's all I got. That's my price target for Verizon. That's what I think for technical analysis of the stock. Thanks for watching this. If you liked it, please hit the like button and subscribe if you want to see more videos like this. And also, let me know if you like these stock videos. I would love to hear from you in the comments below. And another one of my videos is coming up on the end screen. Please watch it right now.